Customers found their venture capital dry up, $42 billion in withdrawal requests. The federal government, fearing a broader collapse, $2.25 billion capital. Asian stock markets weren't spared. In March 2023, the financial world was rocked by an event few saw coming: the sudden collapse of Silicon Valley Bank, the trusted banker to half of America's tech startups and venture-backed companies. What began as a ripple soon became a tidal wave, shaking not just the heart of the tech ecosystem, but the entire banking industry itself. For decades, Silicon Valley Bank was more than just a bank. It was the lifeline of innovation. Founded in 1983 and headquartered in Santa Clara, California, Silicon Valley Bank specialized in serving the fast-growing technology and life sciences sectors. By 2022, it had grown to become the 16th largest bank in the United States, managing billions in deposits from startups, venture capital firms, and private equity. But beneath the surface, vulnerabilities had been quietly building. Silicon Valley Bank's unique clientele, predominantly early-stage companies flush with venture capital, meant that the majority of their deposits were well above the federal insurance limit of $250,000. In fact, nearly 94% of Silicon Valley Bank's deposits were uninsured. While this high concentration of uninsured deposits isn't unusual for a bank that serves startups, it left Silicon Valley Bank exposed to a critical risk. What happens when those depositors decide to withdraw their funds all at once? That risk became reality in early 2023. As the tech boom of 2020 and 2021 began to slow, many of Silicon Valley Bank's customers found their venture capital dry up. Startups that once raised millions found themselves needing cash to cover payroll and operations. The money they had trusted Silicon Valley Bank to hold was suddenly needed all at once. Depositors rushed to withdraw their funds in unprecedented numbers. Over the course of just 2 days in March, Silicon Valley Bank faced a staggering $42 billion in withdrawal requests, the largest bank run on deposits in U.S. history. But why did the bank collapse so quickly? The answer lies in the bank's investment strategy. Silicon Valley Bank had taken the vast deposits it received during the tech boom and invested heavily in long-term government bonds and mortgage-backed securities, assets considered safe but tied up for years. When interest rates were historically low, this strategy made sense. But as inflation soared and the Federal Reserve aggressively raised interest rates from near zero to over 4.5% in less than a year, those bonds lost significant market value. What Silicon Valley Bank could not do was sell these bonds at their full original value without taking massive losses. Yet, with depositors demanding cash, the bank was forced to liquidate these assets at a steep discount, wiping out its capital cushion and shaking depositor confidence further. Financial analyst. When interest rates rise quickly, the value of long-dated bonds falls. Silicon Valley Bank's bond portfolio was a ticking time bomb. They had locked themselves into a position that could not withstand a rapid rate hike. Former regulator. The bank run was a classic example of how liquidity mismatches can lead to insolvency. Deposits are short-term and demandable, but assets can be illiquid and long-term. The panic fed on itself. As Silicon Valley Bank's financial situation became public, the bank's stock price plummeted from $230 to below $40 within weeks. Investors and depositors lost confidence. On March 10, 2023, regulators stepped in. The Federal Deposit Insurance Corporation, FDIC, took control of Silicon Valley Bank, marking the largest bank failure in the U.S. since the 2008 financial crisis. The federal government, fearing a broader collapse of confidence in the banking sector, especially among startups and tech companies, took extraordinary measures. It guaranteed all deposits, even those above the insured $250,000 limit, to prevent contagion. This unprecedented move raised questions about moral hazard, regulation, and the future stability of banks in a world of volatile markets and shifting monetary policy. But this story is not just about a bank failure. It is about the fragility of financial ecosystems, the risks startups face, and the lessons the entire world must learn as we move into 2025, a time when interest rates remain volatile and economic uncertainty looms. In the following parts, we shall explore the full story behind Silicon Valley Bank's collapse, its ripple effects across the global financial markets, and what startups, investors, and policymakers must do to prepare for the risks ahead. Welcome to Case Capital, your trusted guide to understanding complex financial stories and turning them into actionable insights. The collapse unfolds. How Silicon Valley Bank's downfall happened. The collapse of Silicon Valley Bank was not an overnight failure. It was the result of a perfect storm of economic shifts, risky decisions, and a sudden loss of confidence. To understand why Silicon Valley Bank fell so hard, we need to examine the chain of events that led to one of the most dramatic bank runs in history. The story begins during the tech boom of 2020 and 2021. Fueled by a surge in venture capital funding, Silicon Valley startups poured massive amounts of money into Silicon Valley Bank. Deposits grew from $65 billion in 2019 to nearly $189 billion by the end of 2021. This rapid deposit growth was both a blessing and a curse. While Silicon Valley Bank appeared flush with cash, it faced a fundamental banking challenge: the maturity mismatch. The bank invested heavily in long-term, low-yield government bonds and mortgage-backed securities, locking away much of its deposits for years in hold-to-maturity securities. At the same time, the Federal Reserve began raising interest rates sharply to combat rising inflation. From March 2022 to early 2023, the federal funds rate climbed from 0.25% to 4.75%. Why does this matter? Because bond prices and interest rates move inversely. As rates rise, the value of existing bonds falls, especially those locked in at low yields. Silicon Valley Bank's bond portfolio lost billions in unrealized value. When startups began drawing on their deposits in 2022 and early 2023, needing cash for payroll and operations as venture capital dried up, Silicon Valley Bank found itself squeezed. The bank's liquid cash reserves were insufficient to cover the surge in withdrawals. To meet demands, Silicon Valley Bank started selling those long-term bonds at a loss. Economist: selling bonds at a loss erodes a bank's capital base. Once capital is depleted, the bank is effectively insolvent. Silicon Valley Bank tried to shore up confidence by announcing a $2.25 billion capital raise in early March 2023. But the move backfired. Investors and depositors saw the capital raise as a sign of distress, triggering panic. Social media and tech forums buzzed with fear. Startups hurried to withdraw funds, fearing the bank would collapse. Within 48 hours, withdrawals hit a staggering $42 billion. Regulators raced to intervene. On March 10, 2023, the Federal Deposit Insurance Corporation, FDIC, took control of Silicon Valley Bank. It was the largest bank failure since Washington Mutual collapsed in 2008, and the second largest bank failure in U.S. history. The FDIC immediately guaranteed all insured deposits up to $250,000. But in Silicon Valley Bank's case, nearly 94% of deposits were uninsured, creating widespread fear. To stabilize the system, the U.S. Treasury, Federal Reserve, and FDIC announced a joint guarantee to protect all depositors, insured and uninsured alike. Financial analyst: this decision was unprecedented. It aimed to prevent contagion where fear at one bank spreads to others, but it raised difficult questions about taxpayer risk and moral hazard. This extraordinary federal intervention calmed markets temporarily, but the damage had already shaken confidence in banks serving startups and technology companies. A second bank, Signature Bank, also failed days later after suffering a similar run, deepening worries of a banking crisis. Both banks had high proportions of uninsured deposits and invested heavily in long-term securities, a dangerous combination in a rising rate environment. Former regulator: the failure of Silicon Valley Bank exposed the risks of concentrated industry banking, liquidity mismatches, and insufficient regulation. Compounding the problem was deregulation that took place in 2018. Legislation rolled back key provisions of the Dodd-Frank Act, exempting banks with assets below $250 billion, including Silicon Valley Bank, from stringent stress tests and capital requirements. In 2023, U.S. Congress held hearings to investigate Silicon Valley Bank's collapse, debating whether deregulation, poor risk management, or macroeconomic factors were to blame. While the full answer remains complex, experts agree that the bank's exposure to rising interest rates and over-reliance on uninsured tech deposits were the main causes. Startup founder: we trusted Silicon Valley Bank with everything. When news broke, we had to scramble to move payroll funds. It was terrifying. Silicon Valley Bank's collapse was a wake-up call for banks, startups, and regulators alike, illustrating how quickly confidence can unravel and the fragility of institutions built on fast-growing but volatile sectors. As we move into 2025, the lessons from this failure still resonate. The banking sector faces new pressures from economic uncertainty, higher rates, and tighter capital markets. In the next segment, we will explore how the aftershocks of Silicon Valley Bank's collapse continue to ripple through global markets from the United States to Europe, Asia, and beyond, and how the financial world is responding. Global shockwaves. The fallout of Silicon Valley Bank's collapse. When Silicon Valley Bank fell in March 2023, its impact didn't stop at the borders of the United States. Thanks to the interconnected nature of today's financial markets, the tremors were felt across the globe in Europe, Asia, Australia, and beyond. Silicon Valley Bank was more than just a regional bank. It operated subsidiaries in London and had joint ventures in China, servicing tech companies worldwide. Its collapse sent immediate shockwaves through the international banking and startup communities. In the hours following Silicon Valley Bank's failure, equity markets reacted sharply. The European banking index dropped by over 7%, wiping out roughly 120 billion euros in market value. Asian stock markets weren't spared. Japan's Nikkei fell by 2.7%, South Korea's Kospi by nearly 4%, and Hong Kong's Hang Seng by 2.8%. Even in Australia, equity markets rose in a curious reaction as investors flocked to safer assets, though the banking sector saw significant losses. International market analyst. The collapse created a sudden wave of uncertainty. Investors questioned the stability of banks with similar profiles, those heavily invested in long-term securities and exposed to concentrated sectors. The Bank of England even increased the UK's deposit insurance limit from £85,000 to £250,000 temporarily, mirroring the US move to protect depositors. Chinese startup CEO. Silicon Valley Bank was a key partner in funding our growth. When it failed, we had to rethink our financial strategies overnight. Venture capital. Investor. This crisis taught us the importance of diversification not just in investments, but in banking relationships. Companies can't rely on a single bank, especially one so tied to a volatile. Lessons learned and preparing for the future. How to protect your business and investments. Financial analyst. The Silicon Valley Bank failure exposed key vulnerabilities, the dangers of concentration risk, the maturity mismatch between deposits and investments, and regulatory gaps that allowed excessive risk-taking. The fundamental lesson is clear: diversification is critical. For startups and companies, relying heavily on a single bank, especially one deeply tied to a volatile sector like tech, is a risky bet. Startup chief financial officers. After Silicon Valley Bank, we spread our banking across several institutions. It's about managing risk and ensuring liquidity when you need it most. For investors, this means reassessing not just portfolio diversification, but also understanding the financial health and risk exposure of banks where companies hold funds. Financial advisor. Depositors need to know the limits of deposit insurance and avoid keeping excessive funds beyond insured thresholds at any one institution. Another crucial insight is the need for stronger regulatory oversight. The deregulation of 2018 reduced stress tests and capital requirements for mid-sized banks like Silicon Valley Bank, which contributed to unchecked risk accumulation. Policy expert. Policymakers must revisit these rules to close loopholes, strengthen capital buffers, and enhance transparency in bank investment portfolios. Central banks also face a challenging balancing act, raising interest rates to tame inflation while ensuring financial stability. Economist. Silicon Valley Bank's failure highlights the tension between monetary policy and banking sector health. Going forward, central banks must carefully calibrate rate increases and provide adequate liquidity support. For businesses, liquidity management is now a top priority. Maintaining adequate cash reserves and diversifying funding sources can help weather sudden shocks. Entrepreneur. We have to be more cautious about cash flow. The Silicon Valley Bank episode taught us to prepare for worst-case scenarios. At the broader level, Silicon Valley Bank's collapse has sparked discussions about the future of banking for innovative sectors. Should banks be allowed to concentrate deposits and investments in a narrow industry? How can regulators balance fostering innovation with risk management? Experts suggest a multi-pronged approach. Enforce stricter capital and liquidity requirements for banks with concentrated sector exposure. Increase transparency so depositors and investors understand bank risk profiles. Encourage banks to diversify loan and investment portfolios. Promote financial literacy so companies and individuals better understand deposit insurance limits and risks. In a world of economic uncertainty, no one is immune to the risks posed by rapid interest rate changes, sector downturns, or regulatory gaps. But armed with knowledge, vigilance, and proactive strategies, businesses and investors can reduce their vulnerabilities.